there, and welcome to today's daily premium newsletter for May 30th, 2018. So today was another quiet day in the markets, with most of the large caps losing a few percentage points. As we mentioned in our last newsletter, there simply wasn't enough volume to sustain the bullish action we saw yesterday. By far the biggest news today was that President Xi of China openly praised blockchain technology during a speech at the Chinese Academy of Sciences annual conference in Beijing. Xi gave blockchain as an example of a new generation of technologies producing breakthroughs. Look, it's no surprise to us that the Chinese government are receptive to blockchain. Requiring their citizens to tie identity to their wallet, allowing tracking of every transaction each person makes, is a dream for the Chinese social credit system. But at the same time, it highlights the exact position the Chinese government is taking. They love blockchain, but they're not enthusiastic about uncontrolled cryptocurrency. The Chinese already have issues with capital flight from the country and black markets, and it's not as if the Chinese are going to warm up to allowing decentralized economic activity and ICOs without their consent. Meanwhile, today, U.S. federal bank regulators unveiled a sweeping proposal to soften the Volcker Rule, a cornerstone to the 2010 Dodd-Frank law that was enacted in response to the financial crisis. Today's move gives big banks more freedom to make their own complex bets, activities that, as we said last week in our newsletter, can be highly profitable, but leave them more vulnerable to losses and risk the economic security of the global economy. This comes just after last week when President Trump signed into law a bill that will free thousands of small and medium-sized banks from the Dodd-Frank law, which was put into place to prevent banks from making unsafe bets with depositors' money. I think what really stinks about today's decision for changes to the Volcker Rule was that it was lobbied by all 6 of the 6 largest United States banks, either directly or through trade groups. JP Morgan Chase, Goldman Sachs, Morgan Stanley, Wells Fargo, Bank of America, and Citigroup all stand to benefit greatly from today's decision. But the implications cannot be understated. In just a week, regulators have rolled back many of the financial protections put into place to prevent another 2008. And while certainly an argument can be made that crisis-era protections are no longer needed with a strong economy, the tightrope did just get thinner. Whatever the case, crypto assets need to focus on continuing to improve. Ethereum just launched the 1,000th decentralized app, or dApp, on its platform today. While that's certainly a remarkable achievement, only 2 of those dApps have over 1,000 active daily users, with those 2 being exchanges. Even CryptoKitties, the most well-known dApp that brought Ethereum to its knees last December and was recently featured in length by a popular journalism site, Vox.com, only has 536 active daily users. Clearly, Ethereum and the crypto space as a whole needs to find its killer app. We drew parallels to the tech space of the 90s at the end of yesterday's newsletter, and it's once again applicable. The tech space of the 90s was also searching for that killer app, and the internet did not really take off into mainstream adoption until we found the right ways to use it. Social media, cell phones, multiplayer games, B2B operations, e-commerce, streaming, and many more. All of those outlets more or less did not exist in the 90s, or were tiny compared to the billion-dollar industries they comprise today. Look, we'll get there, and it's very conceivable that blockchain's killer app could be an extension or collaboration with other technologies, like artificial intelligence, quantum information, mobile communication, and Internet of Things, as President Xi said. Whatever the case, we're at the start of something big. And so, for his thoughts on today's market, I'll turn it over to Doc. Have a great rest of your day, and we'll talk to you tomorrow.
Good evening. This is Doc for ReadySetCrypto. I've got a Bitcoin chart up here, and yesterday what I talked about was what we'd have to see for the price to start actually heading higher, and I was not impressed because we had no uptrend yet on the 4-hour chart. And so let's go back down to the 4-hour chart and take a look here. Here's that trend line. We're still printing lower highs and lower lows, so one little pop to the upside does not make a reversal, not by itself. So what we have to do is we have to see a transition into an uptrend at the 4-hour chart is good. You can look at the 1-hour chart as well too if you want a slightly more rapid but noisier version of that. And we have to see that not only making higher highs and higher lows, but punching through this trend line before we're going to start to see some green candles show up on the daily chart, and perhaps at that point we'll have some swings to play inside of. Now, you might be asking yourself, well, man, this is awfully boring. There's got to be something that we can do within the space of crypto to play these types of swings. And one answer certainly is to short something during a bear market. So in other words, you sell to open and then buy to close as the price goes lower. Now, I personally do not feel that shorting to open, so this is called naked shorting. I do not believe that naked shorting is a good idea for the majority of crypto investors out there. Unless you've got a much bigger account, you have to realize that it's the flip side of what we do with fixed risk positions. If I buy a fixed risk position, I put $100 into it, then I know that that's the most that I can possibly lose on that position, and I can sleep at night. But if you do the opposite with a naked short position, you have unlimited risk to the upside. And my concern is that many people will freeze once the first rally starts coming along, and they'll do the typical retail thing of, well, it's got to come down sometime. And that usually leads to a margin call. Don't want people to go there. So I do want to show you a possible way to handle this style of trading in a manner that allows us to fix our risk. Before I leave this page, though, I have to call your attention to this obviously earth-shaking article, which is down here in the lower right. Bitcoin may be extinct in 100 years. What a prediction. Okay, this is my fiat broker. This is Thinkorswim by TD Ameritrade. Again, this is a typical US-based broker. But this is the XBT contract. So on the upper left-hand corner, this is the XBT. This is the Bitcoin futures contract as traded by the CBOE. Now, I could also bring up the /BTC contract, and this is the same kind of contract. There are differences in it, though. This is the one that's being printed by the Chicago Mercantile Exchange, the CME. So even though it doesn't look the same here, trust me, these are the same things. It's just the contract spec is much, much different. Bottom line here, do not trade the BTC. Only consider the XBT for right now. Okay, so what is this and what does it do? Well, here's a movement in Bitcoin, and I've got this set up as a tick chart here. And this is Eastern time. We saw this go from this is about 10:30 Eastern time. And so we bottomed out at maybe a couple of hours later than that, and then we've turned up a little bit since then. So we had some pretty strong volume, at least for Bitcoin, in the morning here for about 2 hours. Now, how much would this move make you in a futures contract? So what you can see over here is a ladder. So let's assume that the price was about 7,500 when you entered. Each one of these ticks, which is a $5 price increment as compared with versus the US dollar, each one of these per contract is worth $5. So if you had shorted a contract, if you'd sold to open this, so if I enter this position like this, sell one to open, what I can do is I can set up a bracket order through this. Now, this is actually really cool. You can do these kind of things and fix your risk on the position if you wanted to, right? So if I sell this position up here, my stop loss is in the upper left. Stop loss is so let's just assume that I put this up here. Stop loss is up here. If the price goes higher, then I fix my risk. It's not like a naked short sale, right? This is very, very different. Now, what I do want you to notice here is that there is initial margin, which is held against my position, and it's about $3,300 for this contract. So this is not for your small little account, and you've got to get a futures agreement set with your broker before you can trade these. So that normally also implies that you have a margin account set up as well too, a cash margin account. Now, some of these accounts you can trade within a retirement account. So you can actually do Bitcoin futures within a retirement account, believe it or not. Okay, so keep that in mind. So that is what's called a bracket, or one cancels other order. So I can fix my risk. I've got my profit target down to the downside. I've got my stop loss defined to the upside. Now, again, what I want to mention here is that this move that went from 7,500 down to 7,300, each 100 points of Bitcoin, so if it goes from 7,500 down to 7,400, what that means is that's 20 ticks, or that's $100. So for one contract, this is a $200 move in about 2 hours. Not too bad. So to me, this is just about the right level of margin. Now, if I were to go to the BTC contract, it would be 5 times bigger than that. So for each tick, the one contract is going to move $25 in value. This is way too big for the average retail investor. This is more of an institutional contract. So again, the great thing about futures contracts is I can as easily go short as I can go long. It is not that easy to go short on a coin in crypto. You have to get the right broker. You have to find an issue that's easy to borrow. You've got to be able to borrow those coins from your broker so that you can sell them to open. And oh, by the way, you get hit with an interest rate charge when you do something like that. So there's all kinds of complications, not to mention the issue that you're dealing with something that could gap much, much higher overnight. In some other markets, say there's some news that comes out in Asia, there's some news that comes out in Europe, it could be anywhere, right? So you've got to be watching this thing constantly if you're going to do something like that to limit your risk. And you know that if you put a stop order in, you're going to get stopped out. That's just the way that this market moves. So this to me is a much, much better way of getting short the market. Now, again, the limitation here is that it's only for Bitcoin and nothing else. There's no Ethereum futures contracts, for example. There's no Ripple futures contracts. So here we are. This is 2018. This is the state of the market when it comes to derivatives. You can bet that within a year, you're going to see much, much deeper offerings for this. So in other words, what you may even see is something like this. If we go out here to the XBT and to find this contract, we're not going to see any options down here. This is going to change. We're going to have a much deeper set of derivatives across the markets, and this is only going to be good news. So for some of you that are hearing me say this going, I don't care about this, this all sounds so complicated, I don't get it. Trust me, this has been a revelation to the equities markets in terms of the retail investor. Having better derivatives like this has given us many, many, many more opportunities and has really exploded the world of retail investing and the equities markets. And it's going to do the exact same thing when it comes to the cryptocurrency markets. It's going to allow you to fix your risk much better. It's going to allow you to sell positions for income. You can become your own insurance company, in effect. All right, folks, that is it for tonight's report. Thanks for listening. We'll see you tomorrow.